The global financial system constantly evolves through complex strategies and careful asset management. Central banks around the world continuously evaluate their national wealth to ensure maximum security and liquidity. Observers note that physical gold remains the ultimate symbol of economic stability during times of shifting geopolitical power and market uncertainty. The Bank of France recently executed a highly sophisticated monetary maneuver involving its international reserves. This strategic realignment focused on liquidating a specific portion of precious metal stored overseas. The institution successfully modernized its holdings, while generating an enormous financial windfall for the nation. This operation involved the sale of 129 tons of gold. These reserves were previously held in custody at the Federal Reserve Bank of New York. Following the sale, the French central bank purchased an equivalent amount of modern gold bullion in Europe. The complex transaction took place over a carefully planned period of 6 months. The process began in July of the year 2025 and concluded in January of 2026. This carefully staggered timeline helped the bank maximize its financial returns efficiently. During this specific 6-month window, global gold prices reached unprecedented historical highs. By selling the precious metal at these peak market valuations, the institution achieved extraordinary results. The Bank of France successfully recorded a massive capital gain of approximately 12.8 billion euros. This spectacular profit translates to roughly $15 billion in American currency. The financial windfall completely transformed the balance sheet of the French central bank. It allowed the institution to turn previous significant financial deficits into a net profit for the 2025 fiscal year. In the preceding year, the bank had reported a substantial net loss of 7.7 billion euros. Thanks to the exceptional foreign exchange income from the gold sales, this situation was reversed. The bank ultimately reported an impressive net profit of 8.1 billion euros. The massive transaction was not motivated merely by the desire for quick financial gains. The primary goal of the French Monetary Authority was technical standardization and asset modernization. The gold held in the United States consisted of older bars that no longer met modern international trading specifications. An internal audit conducted in the year 2024 strongly recommended completing the modernization process. The bank had been gradually replacing its older gold reserves with compliant bars over the past 2 decades. The remaining stock in New York represented the final piece of this older arrangement. Modern international gold trading requires bullion to adhere to strict quality rules. The London Bullion Market Association established the highly respected good delivery standards for this exact purpose. These rules dictate that gold bars must possess a minimum purity of 99.5% to be easily traded. The 129 tons stored in New York did not reliably meet these modern purity specifications. In times of severe financial crisis, the central bank might need to rapidly mobilize its reserves for emergency liquidity. Non-standard bars face significant disadvantages in fast-paced wholesale trading environments. Upgrading the old bullion through traditional physical means presented massive logistical challenges. The bank would have needed to securely transport the metal across the Atlantic Ocean. Once back in Europe, the gold would require expensive and time-consuming refining processes to achieve the necessary purity levels. To completely avoid these enormous transportation and insurance costs, the institution chose a highly efficient market solution. Instead of shipping the actual metal, the bank decided to execute a strategic swap. They sold the American stock and purchased an identical quantity of fully compliant gold directly in Europe. This brilliant approach completely eliminated the terrifying custody risks associated with moving large volumes of wealth internationally. Over 26 separate market transactions were carefully executed to finalize this major portfolio replacement. The strategy perfectly aligned the national reserves with the highest standards of international finance. The accounting mechanisms of the euro system played a crucial role in creating the reported windfall. Central banks typically value their gold at current market prices, but keep the gains categorized as unrealized. These paper profits wait safely in special revaluation accounts rather than boosting the annual income statement. Selling the physical gold in New York triggered a massive realization of those previously dormant capital gains. Because the original metal was purchased decades ago at much lower prices, the official accounting profit was staggering. Purchasing new gold immediately afterward established a modernized cost basis in Europe. The total capital gain of 12.8 billion euros was divided across two accounting periods. 11 billion euros were securely booked during the 2025 fiscal year. The remaining 1.8 billion euros were officially recorded early in 2026. By realizing these historical gains, the Bank of France massively strengthened its institutional financial foundation. Net equity for the institution surged to a remarkably robust 283.4 billion euros. This represents a gigantic increase from the previous year balance of 202 billion. The decision to hold the newly purchased gold inside the French capital was highly strategic. Central Bank Governor François Villeroy de Galhau stated the choice reflected European market realities. High-quality gold bars are traded more easily on the robust European continent than overseas in America. He also explicitly denied that the withdrawal was motivated by any underlying political grievances. This subtle diplomatic messaging successfully avoided causing unnecessary tensions with the United States government. The seamless swap maintained global market stability while achieving every single objective of the domestic modernization plan. This specific portion of gold had rested in New York vaults since the 1920s. During that vibrant historical era, Paris itself operated as a premier global hub for precious metals. France frequently deposited portions of its wealth overseas to facilitate complex international trade settlements. By the 1930s, the French central bank possessed a staggering 5,000 tons of gold. Global investors sought desperate refuge in the French franc during the turmoil of the Great Depression. The nation maintained its firm commitment to the gold standard longer than neighboring powers. Following the Second World War, the Bretton Woods system radically changed global financial dynamics. The American dollar emerged as the dominant reserve currency universally pegged to gold. Consequently, the Federal Reserve in New York became the unquestioned epicenter of international precious metal storage and clearing. In the 1960s, President Charles de Gaulle famously questioned the enduring stability of the American dollar. He strongly suspected that persistent trade deficits would inevitably lead to devaluation. He aggressively demanded that French dollar holdings be systematically converted into physical gold and brought home. The French Navy was dramatically deployed to physically transport the country's sovereign wealth back across the Atlantic. Between 1963 and 1966, more than 3,000 tons were repatriated. This fierce display of economic independence deeply rattled the prevailing global monetary order. Despite that historic mass withdrawal, a quiet residual stock of 129 tons remained untouched. This small fraction sat quietly in New York vaults for another 6 decades. Most citizens and policymakers completely forgot about this lingering overseas deposit until recent modernization audits. Today, all 2,437 tons of French gold reside securely within national borders. This massive stockpile represents the fourth largest sovereign gold reserve anywhere on the planet. France takes immense pride in safeguarding its own monetary anchor without relying on foreign custodians. The newly acquired compliant gold bars now rest in the legendary La Souterraine underground vault in Paris. Built nearly a century ago, this incredible subterranean fortress lies 29 meters below the river. The facility spans an astonishing 10,000 square meters of highly protected space. Over 700 massive pillars support the ceiling of this uniquely constructed architectural marvel. Originally designed to survive heavy aerial bombardments, it has undergone continuous security upgrades since the 1920s. Today it features autonomous power generation and completely independent oxygen supplies for ultimate resilience. By centralizing its entire gold reserve, France has achieved what experts call absolute financial sanctuarization. Keeping the most critical monetary assets firmly within domestic jurisdiction prevents any potential interference by foreign governments. This approach guarantees unhindered access to wealth even during the most severe global crises. In the event of international payment system failures, the Bank of France can now immediately mobilize these compliant bars. Holding liquid good delivery standard gold provides a flawless medium of exchange of last resort. This readiness forms the backbone of a truly sovereign European economic defense. The successful repatriation and modernization executed by France highlights a growing trend among multiple world nations. Central banks increasingly desire direct physical control over their strategic reserves in today's highly fragmented geopolitical landscape. Recent global asset freezes have severely diminished trust in traditional offshore storage models. Countries like India and Serbia have actively begun bringing their own sovereign gold back home. Even smaller nations, such as the Netherlands, are quietly moving their wealth out of foreign jurisdictions. These coordinated actions firmly signal a profound shift toward prioritized national self-reliance and protection. France's perfectly executed maneuver has subsequently intensified intense political debates right across the border in Germany. The German Federal Bank currently stores over 1,236 tons in New York. This enormous volume accounts for approximately 37% of total German reserves. The ongoing debate in Germany highlights the massive political sensitivity surrounding sovereign gold kept overseas. German citizens frequently express deep anxiety about their national wealth remaining under foreign physical control. The French solution proves that resolving these intense public concerns does not require risky physical transportation. Consequently, the German Federal Bank faces mounting demands to swiftly replicate the successful French strategy. Securing over 1,000 tons of wealth through a simple market swap appears incredibly logical. However, authorities in Berlin remain cautious and have not yet committed to such a massive undertaking. Prominent German economists are increasingly vocal about the perceived risks of leaving such wealth abroad. Michael Jaeger of the Association of German Taxpayers has strongly demanded immediate action from Berlin. He openly argues that unpredictable American policies compromise the safety of foreign assets stored there. Although the German central bank has not formally announced any plans for a complete withdrawal, the pressure mounts. The flawless financial execution demonstrated by the French provides a compelling template for Germany. Selling older stocks abroad and repurchasing compliant bars locally solves multiple logistical nightmares simultaneously. The massive profitability of the French operation proves that upgrading reserves can be incredibly lucrative. Recording a $15 billion gain while simply moving wealth closer to home is undeniably attractive. Other nations are certainly analyzing this specific swap maneuver to optimize their own sovereign portfolios. Interestingly, the broader global gold market has seen significant fluctuations and intense buying recently. While France successfully completed its strategic quality upgrade, other central banks simply accumulate more tonnage. Countries such as Poland and China continue to purchase fresh gold every single month without hesitation. During the identical period when France was executing its delicate New York swap, prices soared. This general appreciation of the precious metal added undeniable momentum to the profitability of the trade. The general market appetite for gold ensures high liquidity whenever a sovereign seller steps forward. Unlike nations actively increasing their overall reserve volume, France opted for uncompromising qualitative refinement. The strict maintenance of a 2,437-ton reserve proves highly sufficient. By maximizing the actual liquidity and trading readiness of its stock, the bank acts quite prudently. The Bank of France still has more work ahead to finish its ambitious modernization agenda. While the American reserves are fully resolved, there remains an isolated domestic stock requiring attention. Approximately 134 tons of older bullion and historic coins still sit in Paris. These legacy assets do not currently comply with the strict good delivery international benchmark requirements. The central bank explicitly intends to bring this final portion up to standard soon. Authorities have set a firm target date of 2028 to finalize this domestic upgrade. It remains entirely possible that the bank will utilize a similar financial mechanism once again. They could patiently wait for optimal market conditions before selling the non-compliant coins. By simultaneously purchasing standard ingots, they could potentially capture additional accounting profits over the next 2 years. This ongoing pursuit of impeccable asset quality reflects a profound understanding of modern financial crises. In severe scenarios, illiquid or irregular assets become practically useless for urgent sovereign stabilization. Having exactly 2,437 tons of perfectly tradable gold is a massive advantage. This transformation perfectly positions the central bank to navigate future economic challenges with absolute confidence. Their modernized balance sheet provides tremendous resilience against any sudden shifts in European monetary policy. A robust net equity protects the institution from the unpredictable waves of global currency inflation. The European financial community has carefully monitored this clever maneuver since the initial press release. Analysts clearly recognize the brilliance of utilizing prevailing market highs to offset past losses. It represents an elegant solution that neatly sidesteps the immense friction of typical international gold transfers. Some critics initially questioned whether the United States was forcing foreign partners to retrieve assets. However, French officials vehemently denied any such geopolitical friction behind this specific trading action. The sheer logistical difficulty of moving non-standard ingots across the ocean justified the sale completely. It is fascinating how modern central banking still fundamentally relies on this ancient precious metal. Despite decades of digitalization and complex fiat currency systems, physical bullion remains universally trusted. No other financial instrument provides the same level of unquestioned security during times of geopolitical panic. The dramatic transformation of the French balance sheet serves as a masterclass in reserve management. They seamlessly merged an essential technical upgrade with an extraordinary opportunity for massive profit realization. Such perfect timing is rarely achieved by large bureaucratic institutions dealing with highly illiquid assets. Many financial commentators have noted the profound irony of turning paper losses into hard gains. While some central banks struggle with negative equity, the Bank of France successfully outmaneuvered everyone. Their accounting agility converted dormant historic investments into active capital, supporting the entire national economy. Looking back at the 1960s operation, Charles de Gaulle would likely approve of this outcome. His fierce insistence on bringing the national wealth home laid the initial foundation for this reality. By securing the final fraction in Paris, his historic vision is now totally fulfilled. The global environment remains fraught with tremendous uncertainty regarding trade tariffs and international military conflicts. Consequently, securing supreme control over national financial reserves has never been a higher priority. The French approach powerfully demonstrates how to achieve maximum security without triggering unnecessary diplomatic or economic disruptions. Observers must recognize that physical gold still dictates the ultimate terms of sovereign wealth preservation. Even as digital currencies and complex derivatives multiply, the enduring stability of bullion reigns supreme. The Bank of France clearly acknowledges this fundamental truth by maintaining their massive 2,000-ton reserve. As other European nations grapple with their own dispersed foreign holdings, the French example shines. They have provided a seamless operational blueprint for safely repatriating and modernizing legacy wealth. It eliminates the incredibly risky logistics of transporting heavy metals through potentially hostile or vulnerable international waters. Financial analysts continuously debate the true long-term impact of such massive central bank operations. However, the immediate accounting triumph achieved by the French institution is beyond any reasonable dispute. They literally manufactured a multi-billion euro profit simply by updating the format of their assets. The sheer elegance of this financial maneuver guarantees its place in future monetary policy textbooks. It demonstrates how agile market thinking can solve seemingly intractable logistical and historical problems. This proves that even conservative central banks can execute highly creative strategies when conditions are perfectly aligned. The final remaining challenge will be standardizing those final domestic coins by 2028. Once that specific milestone is reached, the entire French Reserve will be absolutely flawless. The nation will possess unparalleled financial security, backed by the highest quality physical assets in existence. Ultimately, the Bank of France has significantly elevated the standard for sovereign wealth management worldwide. By actively monitoring global markets and understanding complex accounting rules, they unlocked massive hidden value. Their actions unequivocally reaffirm the permanent importance of physical gold in maintaining true national economic independence.